Welcome to the deep dive. Today, we're going to get into a specific financial instrument.
That's right. We're looking at the EquiTrust MarketMax Index Annuity based on info from Diversified Insurance Brokers.
Our goal is really just to pull out the key bits,
Mm.
understand what it does without getting lost in the weeds.
Exactly. Cut through the jargon and see if it's something that might fit someone's long-term goals.
Okay, so let's start at the top. This MarketMax annuity. It seems to be about growing money long-term, but also, crucially, protecting it from market drops.
Precisely. It's designed for that tax-deferred growth, but with a buffer against market loss. You get potential upside participation without the direct downside risk to your principal from the index itself.
Interesting. So you get some market exposure, but your initial money is, well, safe from index declines.
Yeah, that blend of growth potential and safety is really the core appeal here, I think.
Right. And how does it actually achieve that? It mentions different crediting strategies.
It does. You allocate your premium across different options. There are standard accounts and then these rate buy-up accounts.
Buy up.
Yeah.
Okay, what's that involve?
So with the rate buy-up, you pay an annual fee. It's 1.50%. But in return, you potentially get enhanced cap rates or participation rates.
Okay, hold on. Cap rates and participation rates. Quick refresher.
Sure. A cap rate is essentially the maximum interest rate you can earn linked to an index for a specific period. Think of it like a ceiling.
Got it. And participation.
A participation rate determines what percentage of the index's positive change you actually receive. So 100% participation means you get the full index gain up to the cap, of course.
Makes sense. So the fee potentially boosts those limits.
Exactly. It gives you the potential for higher credited interest if the index performs well.
And which indices are we talking about here?
You've got options. The S&P 500, which is pretty standard. Then there's the S&P MRC 5% excess return index, and also the Barclays Focus50 index.
And if you don't want the fee?
There are non-fee accounts too, so you have flexibility there. Options like a one-year point-to-point cap or participation crediting.
Point-to-point meaning they measure the index change from the start of the year to the end?
That's the idea. And importantly, any interest credited annually is locked in. It can't be lost due to future market downturns.
So your gains are secure year to year.
Right. And your principal is protected from index losses. Plus, you can shift your money between these strategies each year on the contract anniversary.
Okay, so growth potential, protection. What about just accessing the money? Liquidity.
Good question. There are features for that. After the first contract year, you can typically withdraw up to 10% of the accumulation value each year, free of charge.
Okay, 10% free. What if you need more or need it sooner?
Well, that's where surrender charges come in. They apply for the first 10 years and decrease over time. There's also something called a market value adjustment, or MVA.
MVA. How does that work?
It can increase or decrease the amount you receive on withdrawal beyond the 10% free amount based on how interest rates have changed since you bought the annuity. It applies during the surrender charge period.
Right, so it's something to be aware of for early access.
Definitely. But there are often waivers for certain situations, like needing nursing home care or if you're diagnosed with a terminal illness. These might let you access more funds without those charges.
That's good to know. What about guarantees? People like guarantees with annuities.
Absolutely. There's a minimum guaranteed contract rate stated in the contract. And importantly, there's a guarantee that at the end of the term, you'll get back at least 87.5% of your premiums paid, minus any money you've already withdrawn.
So a baseline guarantee there.
Yes. And if the owner passes away, the death benefit is the full accumulation value paid out to beneficiaries without surrender charges or that MVA.
Okay. And contributions. Is it just a one-time thing?
No, you generally have flexibility. You can often start with a lump sum or make ongoing contributions depending on the specifics. And there's always a free look period right after you buy it, usually 10 days or more, where you can review everything and cancel if it's not right for you.
Pretty standard, yeah.
So pulling it all together, this kind of annuity, the MarketMax, seems positioned for someone looking for that long-term accumulation, maybe for retirement.
But who's also, quite concerned about protecting their principal from market volatility.
Exactly. The rate buy-up offers a way to maybe enhance growth, but you've still got that baseline protection.
So for listeners thinking about their own plans, it combines that downside protection with different ways to potentially capture some growth.
It could be quite a compelling option depending on individual circumstances and risk tolerance.
Which leads to the final thought for today. Thinking about your own long-term financial picture, how might a tool like this index annuity fit in? What other questions does it raise for you about balancing that need for growth with the desire for security as you plan